You've seen it in the movies, right? The trader staring at a wall of screens who makes a fortune with just a few clicks of a mouse. That's the Hollywood version of day trading, this really appealing picture of financial freedom. But what's the real story behind the glamour? That's what we're here to do, separate the hype from the truth. So let's get right to it. It's the million-dollar question, isn't it? Can you actually get rich doing this? That's the big question we're going to tackle today by looking past the flashy ads and digging into the cold, hard data. First up, let's talk about the why. What is it about day trading that's so, well, magnetic? What draws so many people in? At its core, it's the promise of a totally different kind of life, one that's powered by today's digital marketplace. And I mean, this says it all, doesn't it? The dream of being your own boss, escaping the 9-to-5 grind, working from literally anywhere you want. The idea that you can achieve total financial independence with just your own wits and a laptop, it's an incredibly powerful fantasy. Okay, so we get the dream, but how does this whole thing actually work? What are the nuts and bolts behind the screen? Let's break down the fundamentals. So the first thing to get straight is that a day trader is not a long-term investor. They don't really care about a company's 10-year plan. They live in the now, in minutes and seconds. They're making tons of trades, trying to skim tiny profits off of tiny price swings. And there's one golden rule. You're in and you're out before the market closes for the day. No holding positions over. And to do this, they have a whole playbook of strategies. You've got scalping. Think of it like picking up pennies 1,000 times a day. Lots of tiny, tiny wins that hopefully add up. Then there's range trading, which is basically betting that a stock will just bounce between two predictable prices, a floor and a ceiling. Others just trade the news. A big announcement hits, things get chaotic, and they jump in to ride the wave. And then you have the big guns. High-frequency trading, or HFT. This is where supercomputers make thousands of trades a second, finding tiny market glitches that a human could never, ever spot. Now, hold on. You can't just fire up your laptop and start making hundreds of trades. There are rules. Big ones. And this is where the dream starts to meet a major reality check. You see, if you trade frequently in the US, the regulators will slap a label on you, a pattern day trader, or PDT. And trust me, this isn't just a fancy title. It triggers some very specific, very strict rules that are designed to make sure you can actually handle the massive risk you're taking on. And here it is, the big one. The rule that stops most aspiring traders dead in their tracks. To be a pattern day trader, you must, at all times, maintain a minimum of $25,000 in your account. So why such a huge number? Well, it's pretty simple. The regulators want to be sure you have a serious financial cushion to absorb the losses that are, believe me, gonna come. It puts up a pretty high fence, sending a very clear message. This is not a casual hobby. This is a high-stakes profession. Okay, so let's say you've got the cash. You've studied the strategies. Now we need to have a serious talk about the odds. This is where we leave the dream world behind and confront the cold, hard, data-driven reality of day trading. You might want to brace yourself for this one. Across countless studies, from academia to the industry itself, the conclusion is startlingly consistent. It's estimated that up to 95% of all day traders ultimately lose money and quit. And they're not just unlucky. They're getting eaten alive by transaction costs, and they're competing against pros with way better technology. And look, this isn't just someone's opinion. This is a conclusion backed by decades of research. The data points to one undeniable fact. For the vast majority of people who try it, day trading is simply not a profitable venture. And if you need a picture, well, here it is. This chart shows the result of a major study in Brazil that tracked thousands of day traders for over a year. And the result? A staggering 97% of them lost money. Just look at that tiny sliver on the right. Only 3% managed to break even or turn any kind of profit at all. This table really clarifies the difference. Long-term investing is like planting a tree. It's a slow game focused on a company's fundamental value over years. Day trading, it's a high-frequency sprint driven by technical charts and breaking news with much higher tax rates on any gains you might make. They are fundamentally different sports. So, knowing those overwhelming odds, what does it actually take to be in that tiny minority that succeeds? If it's not just luck, what is the winning formula? What's the secret sauce? Well, the truth is, it's not one thing. It's everything. You need a ton of capital, way more than that 25K minimum, just to absorb the losses. You need deep knowledge of how markets really work, not just how to read a chart. You need professional-grade technology. But more than anything, you need iron discipline to stick to your plan without letting fear or greed take over. Mastering all of these is what separates the successful few from everyone else. And that brings us to our final thought. The allure of day trading is powerful, but the reality is brutal. So the question isn't just, can you win? But knowing the immense risks and the razor-thin odds of success, is this a game you're truly prepared to play? Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.